Another trading week in 2023 is in the books, and the bulls are still in control with the Nasdaq leading the way. What's up everyone, it's Brandon from Amphibian Trading, and welcome to another weekend update. As always, make sure you hit that like and subscribe button so you don't miss any future updates. With that said, let's get into it. Last week, I laid out what I thought was a perfect scenario for a move higher and showed you how under the surface the Nasdaq had started to lead. This week, we got exactly that. The Nasdaq pushed higher by over 4% and added 2 additional follow-through days, one on Monday and one on Thursday. Now, one thing I want to point out is a big change in character we've seen since the January 6th follow-through day that kickstarted this latest rally. Starting at that original follow-through day, 10 out of 15 days have been positive closes on above average volume, and 5 of those days have been follow-through days, which again is a gain of 1.25% or more on volume higher than the previous day. That's a sign of some serious institutional buying. Another sign of a strong rally is you see many days where the close is higher than the open. Since January 6th, we've seen that 11 times out of the 15 trading days. The Nasdaq on Friday also closed above its 200-day moving average for the first time since January 14th of 2022. And the market stoplight indicator continues to show 2 green lights. Last week, I showed you how breadth had been improving using the percentage of stocks over the 50-day and 200-day moving averages. This week, I want to take a look at the history of the market stoplight indicator as another way to show the health of the market. The market signal is what you see on top, and the net highs and lows signal is the one you see on the bottom. So the way the signal works is if price is above a rising 21 exponential moving average, the market light is green. If price is above a falling 21 EMA or price is below a rising 21 EMA, the light is yellow. And if price is below a falling 21 EMA, then it's red. And then for the net highs and lows portion, if there's a streak of 3 days or more of net highs, the light is green. If there's a streak of 3 days or more of net lows, it's red. And anything in between there is yellow, signaling chop. So looking at the signal now, you can see both signals are green. And the last time we saw that was in July when the market had a nice tradable rally that stalled just short of the 200-day moving average. However, if you look at that period, and especially the volume, you don't see nearly as much accumulation as we are seeing now, and there were actually multiple distribution days. Since that rally faltered, there really hasn't been any time when both signals were green, showing a strong market. Even in late November, early December, the market signal had been green, but if you look at the net highs and lows, it was consistently yellow or red. So this is just another way to look at what's really happening in the market and to know if there is broad participation or just the heavily weighted stocks and the indexes influencing price. Right now, both signals are aligned and the market is acting very healthy. Let's go ahead now and flip over to the S&P 500 where we had a golden cross take place this week with the 10-week moving average crossing above the 40-week moving average. This is the first time since February of 2022 that these moving averages have been aligned positively. The price and volume action remains strong here as well. However, it seems the S&P will have another hurdle at the 4,100 level where it got rejected from twice in December. Right now, price is sitting just below that level, and it wouldn't surprise me to see a brief pause here. Both indexes have rallied strongly over the last few weeks, with many individual stocks moving up even more and becoming extended. We also have the FOMC meeting coming up this week, so a few days of consolidation before that wouldn't be surprising, and it actually would be healthy to allow moving averages to catch up to price. So overall, the action remains strong on the indexes and many individual names are acting great as well. It is important though that after such strong moves, you don't chase extended stocks as some back and fill is to be expected. It's important not to give in to FOMO or think you have to buy something just because the indexes are moving higher or you see somebody posting on Twitter about all this money that they're making. Discipline and precision with your entries is going to be key for getting yourself positioned with the best stocks. Thank you for watching, and if you enjoyed this video or found any of the information useful, please go ahead, hit that like and subscribe button so you don't miss any future updates.